Hello, I'm Professor Brian Boucher. Welcome back. In this video, we're going to dig deeper into Wolff Junction's ratios by looking at sub-ratios within the profitability and turnover categories. This will allow us to pinpoint what specifically is going well for their profitability, what specifically is going well for their turnover, and tie that back to their strategy so that we can get a sense for what in Wolff Junction's strategy is really paying off and giving them an advantage over their competitors. Let's get started. We're going to expand our DuPont ratio analysis framework by digging more deeply into the profitability and efficiency ratios. So we'll look at some sub-ratios under profitability and some sub-ratios under asset turnover. So first we're going to look at the profit margin ratios. Here the goal is to figure out what are the drivers of profitability. So what we're going to do is decompose profitability or return on sales by various important income statement line items. So first we're going to look at gross margin. That's gross profit, which is sales minus cost of goods sold, or the markup of the selling price over cost of producing the goods divided by sales. Then we'll look at the SG&A expense to sales ratio. That'll give us a sense of whether we're controlling all the other costs of running the business. We'll look at operating margin, which is a combination of the markup over cost, gross margin, and all the other expenses, SG&A. We'll look at interest expense to sales to get a sense of how financing is affecting profitability, although that's not part of the ROS ratio that we calculate. And then we'll look at the effective tax rate, which is income taxes as a function of pre-tax income.
Seriously? I see a mistake on this slide. For the effective tax rate, you divided by pre-tax income instead of by sales.
No, this is actually not a mistake. By dividing income tax expense by pre-tax income, we get a tax rate which is easier to interpret than income tax expense to sales. For instance, if we divide by pre-tax income and come up with an effective tax rate of 36%, you could compare that to the tax rate in the company's country and state and municipality and see whether that seems high or low. But if I told you their ratio of income tax expense to sales was 0.5%, it's much harder to interpret. So by putting this as a tax rate, it's easier for us to think about whether it's high or low for the company. So let's pull up the spreadsheet for Wolff Junction. And what we can see is they had the increasing in return on sales, their profitability over time, which we said last video was the secret to their success. Now we can dig into the sources of this improvement in profitability by looking at the different sub-ratios. So first we have gross margin, which remember is the selling price minus the cost of the goods. So that gross profit divided by sales, it's like the markup over cost. And that has been steadily increasing over the period from 35% up to 40%. So that clearly has driven their profitability. What could explain that? Well, if we go back to the facts of the case, it could be the strategy of trying to control costs. So remember, they have a limited number of items or limited number of styles they keep in stock, which could control their production costs. They manufacture their clothing under a private label using their own suppliers, and they have a lot of suppliers, which may allow them to play suppliers off of each other to get really good deals on the cost. And also they did the regional distribution centers so that inventory wasn't stuck in stores where it might be selling slowly, but instead was in a warehouse and then sent to whatever stores were selling things quickly. And what's striking about this is they also have the strategy of selling older stock at reduced prices, slashing the prices to get out the door. Normally that would reduce gross margin. Doesn't seem to be having a major effect here, which means they've been managing their old styles really well so that they don't have a lot of it. The other reason this might be going up is on the price side. So for a given level of cost, they're able to charge a higher price. And this could be the payoff from their strategies to establish their brand name. So their heavy spend on advertising and celebrity endorsements could be paying off here. The next ratio we have is SG&A to sales. So this is the ratio of all the other expenses of running the business, sales force, marketing, advertising, top management, human resources, so forth. That has been trending upward. And then it sort of leveled off in 2015. So we cannot say that controlling these costs have been a secret to their profitability. Actually, these costs have been starting to creep up. And that might make sense because any increase in advertising or promotion costs are going to show up in the SG&A. So it looks like Woof is doing a strategy where they're willing to incur some extra SG&A costs in order to get a higher markup over cost. Operating margin is the combination of those two, so it's been trending up, showing that this increase in gross margin is more than offsetting the increased expenses in SG&A. Then we have interest expense as a percent of sales, fairly flat, not a big deal for Woof. And then their effective tax rate shows that they're paying a slightly lower tax rate, about 3% over this period. We don't have any facts in the case to tell us what it is, but that also will help their profitability if they're able to find ways to control and reduce their tax burden. Next, we're going to look at the sub-ratios under the asset turnover ratio. And these are going to tell us how many times per year do we cycle through a given account. For example, when we look at inventory turnover, if the value is 8, it means that we build and then sell the inventory 8 times during the year on average. So we'll get accounts receivable turnover, which is sales divided by average accounts receivable. That'll tell us how many times during the year did we create accounts receivable through credit sales and then collect the cash. Inventory turnover is cost of goods sold over average inventory. We use cost of goods sold because that's the cost of the inventory that we sold. That's what we want to compare to the average inventory during the year. And I told you how to interpret that just a second ago. Accounts payable turnover is purchases over average accounts payable. Purchases are the amount of inventory that we add during the year, either through manufacturing or buying the inventory. And that can be calculated using this equation here, ending inventory plus cost of goods sold minus beginning inventory. What this tells us is how many times during the year do we create an accounts payable because we got something from a supplier and then eventually pay it off. And then finally, we have fixed asset turnover, which is sales over average net property, plant, and equipment. What this is going to tell us is how much sales do we generate for our investment in property, plant, and equipment.
What? These ratios make about as much sense as a Texas turtle buying a parka and muklex.
I completely agree. Not about the Texas turtle, but about the fact that these turnover ratios are hard to interpret. So let me give you another version of these ratios, which I find much more intuitive. Now let's transform these asset turnover ratios into days outstanding ratios. These ratios are going to tell us how many days on average a given account is outstanding. For example, if we had days inventory of 45, it means that it takes 45 days on average from the time we start building inventory until the time that we sell it. So the first ratio we'll look at is we'll transform accounts receivable turnover into days receivable outstanding or days sales outstanding. And the way to do this transformation is we just take the inverse of the turnover ratio and multiply times 365, and voila, we get this interpretation of number of days it takes for our customers to pay us. Days inventory is 365 times the inventory turnover ratio inverted. And as I said before, that's the number of days it takes to build inventory and then hold it until we sell it. Days payable, same idea. It'll give us the number of days it generally takes us to pay our suppliers after we receive something from them on account.
Dude, what do you like doing leap years? They have 366 days, you know.
So when I first learned these ratios, I was taught to use 360 days, not 365, because 360 made it much easier to do the calculations on our slide rules. So these are only rough approximations, and if you ignore the day in the leap year, you'll be fine, as long as you ignore it consistently for all the companies that you look at with these ratios. Then we can put these 3 days ratios together into something called the net trade cycle. And the net trade cycle is going to represent the gap between cash outflows and cash inflows that we would have to bridge with short-term borrowing. It's defined as days receivable plus days inventory minus days payable. Let me show you the interpretation of this. So at some point as a business, you get raw materials from suppliers, and then you owe them money under accounts payable. You would take those raw materials, turn them into finished goods, sell those finished goods. The number of days it takes to do that is your days inventory. So let's say it's 50 days. It means from the moment you get raw materials, it's 50 days on average until you sell the inventory. When you sell the inventory, you don't get cash yet. Instead, you sell it on account to customers, and you have accounts receivable. The days receivable tells you how many more days it's going to take until you finally collect cash. So let's say it's 30 days. So that would mean it's 80 days total from when you first get raw materials to when you collect cash from customers. Then on the other side of the cash equation, you have to pay your suppliers. So the days payable is the number of days it takes you to pay your supplier. That's when you have cash going out. So let's say that's 35 days. What that leads to is a net trade cycle, which is the gap between when you get cash in from customers and when you pay cash out to your suppliers. In this case, it's 45 days. And so what that represents is you'd have to go to a bank to borrow money for 45 days to bridge this gap in cash flow. So let's take a look at the breakdown of the asset turnover ratios for WOOF Junction. As we saw last video, there wasn't much in terms of a clear trend in their asset turnover overall, but that doesn't mean that there's not interesting stuff going on in the subcomponents. So I give you both the turnover ratios and the days ratios. You can choose whichever one you want to look at. I'm going to focus on the days ratios. So for WOOF, the days receivable are minuscule. It's 1.3 days from when they make the sale to when they collect the cash. Why is it so low? Because they don't have their own credit card. They don't provide their own credit to customers. All of their sales are either cash or outside vendor credit cards like Visa, MasterCard, American Express, in which case, even though the customer may not pay their Visa bill for 30 months, Visa pays WOOF Junction within a couple days. So this is something that if they ever decided to add their own credit card, this days receivable would certainly go up. Days inventory, so this is the number of days that you have to hold the inventory until it sells, has gone from 87 days down to 68 days. So an improvement of almost 20 days in terms of holding inventory. This we could probably attribute to their point of sale technology, where they're trying not to hold a lot of inventory stuck in these malls, but instead have it in a central place and then farm it out to the places that are really selling it. Also, this reflects their strategy of slashing prices to get rid of old stock every 2 months. So they just don't hold inventory for a long period of time. Days payable, the number of days it takes them to pay their suppliers, it's hung constant around 30 days, so not much going on here. Putting those together, the net trade cycle, used to be it took about 55 days of bank borrowing to bridge this gap between cash outflow and cash inflow. Now it's dropped to 37 days, and that's pretty much all driven by their improvement in their days inventory. One turnover ratio I will look at, because we don't have it in days form, is fixed asset turnover. So this represents the amount of sales that WOOF is able to generate for their investment in property, plant, and equipment. It's actually gone down over time, which normally would be bad news because you're not generating as much sales for your investment in PP&E. But in the case of WOOF, it's a little more complicated because they're growing rapidly, adding a lot of new stores. And what might happen is there's a little bit of delay where there's big capital expenditures to add stores this year, but it may take a couple years for those sales to materialize. So this is something that we would hope would rebound and come up in the future, but right now it may be depressed by their heavy investment in new stores. Before we wrap up, we should compare the ratios for WOOF Junction to ULA Lab and to the industry group as a whole. And what I'll do is for WOOF, I'll show the most recent year and the average. The most recent year is interesting because there have been these upward trends in some of these ratios. So first what we find is WOOF has a much higher gross margin than ULA Lab and the industry as a whole. And while WOOF has had increasing gross margins, we don't see that in the comparators. So this shows that a big source of WOOF's advantage right now is this markup over cost. WOOF has a higher SG&A to sales than ULA Lab, but lower than the specialty group. Part of what's going on here is WOOF is spending more on advertising. and so they're going to have higher SG&A than ULA Lab. When we compare the operating margins, the average is the same, although WOOF has higher operating margin in 2015 than ULA Lab. And so what that's saying is the extra advertising is being offset by the improvements in gross margin, and so they end up having a higher operating margin than ULA Lab. Then if we look at the effective tax rate, it's actually on average higher for WOOF than ULA Lab, although ULA Lab has had a lot of volatility in this. But I think you can say these are fairly comparable, and that WOOF's big advantage over its competition is it's able to get this higher gross margin. If we look at the days ratios, we find that days receivable is much lower for WOOF than ULA Lab in the industry. That's because ULA Lab has a credit card. I mean, who doesn't have an ULA Lab credit card at this point? Whereas WOOF hasn't done that yet. So that's why there's a big advantage for WOOF in terms of lower days receivable. Days inventory, even though it's been trending downward for WOOF, it's higher than ULA Lab. Days payable is sort of similar. It's a little bit longer for WOOF. If we look at the net trade cycle, substantially lower for WOOF than it is for ULA Lab. And what's going on here is even though they have the inventory a bit longer, not having their own credit card causes them to not borrow as much as ULA Lab. On the other hand, WOOF is not getting the credit card income. So one of the things WOOF has to think strategically is if they add the credit card, they'll get credit card income, but they're going to have to borrow from the bank a bit longer because their days receivable will go up. But overall, we can see that WOOF has made good progress in their inventory. Still not as good a shape, though, as ULA Lab. And the big advantage in their profitability is this gross margin, which is substantially higher. So the ratio analysis so far has shown us that WOOF's big advantage in profitability is their gross margin. And that ties back to their branding strategy, which allows them to charge a higher price for their goods, and to their cost containment strategies, which is reducing the production cost for their goods. Now, the ratio analysis can't tell us which one of those two is more important or how much they are contributing to gross margin, but at least we're at the point where we know to try to gather more information about that, either if we have a chance to ask management or to try to read about this in competitors or other sources to try to figure out what is really driving the advantage for WOOF. Is it branding, cost containment, or both? Similarly, the efficiency analysis has shown us that WOOF has great advantages in their low days receivable and their improving inventory turnover, which again, we can tie back to specific parts of their strategy. But the ratio analysis won't tell us how sustainable those are into the future, but at least it's highlighted that we need to figure out, can WOOF sustain its low days receivable, its improvement in inventory turnover, in order for it to have these advantages going forward. So that wraps up our look at the profitability and efficiency of WOOF. In the next video, we're going to turn our attention to liquidity ratios. I'll see you then.
See you next video.